Hey guys, Jack Gleason with StartupTrading.com, and in this video I'm going to be talking about what to look for when the market is gapping down specifically, and how to trade that, how big the gap is, and what you should do. Should you fade it? Should you not fade it? Now, the gap is, for those of you guys who don't know, I'm just going to quickly go over some basics about a gap. Futures gaps happen during the overnight session, basically when the market opens at 6 o'clock East Coast time. The futures will trade all night long into the 9:30 open. So in Thinkorswim, I can go here. Actually, if you don't have the study, you can click this nut up here, go to futures, and show extended trading sessions. And if I apply that, turn it off, that'll show you what is this gap, where this price no longer exists because the market closed here and it opened the next day here. So all of the price action in that overnight session can be removed, and you can see where the market is gapping. Now I have a quick setting on Thinkorswim so I can toggle it on and off, and I always pay attention to both what the market looks like with the extended session turned on and what the market looks like with the extended session turned off. Moving into what was Tuesday of this week, and in the last week of September, last trading week of September, there was a pretty large gap down, and I'm going to go to a 10-day 5-minute chart and show you guys what this looks like. Now, a couple of the indicators I have on my screen I'm going to describe to you. One of them is these blue lines. These blue lines represent what is the prior day low and the prior day high. So going into Tuesday, our open here is the open of this candle. It's like, looks like 4,400 roughly, which the prior day low, which was Monday, was 44.17. So any gap larger than 10 points, you need to be aware that we are most likely going to continue in that direction. That's called a professional gap, where price is really in agreement that we are going to, move potentially in that direction. So we gap below what was Monday's low. We gapped right to, or actually just fairly below, Friday's low, and even gap below Thursday's low. So there was 1, 2, 3 different daily lows that we had taken out, and we had opened up actually into the middle of what was the gap up from Wednesday to Thursday. Now, when we gap larger than 25 points, or I'm sorry, 10 points, don't look to take a trade in the first 25 minutes that opposes the direction of the gap. So if we are gapping down and we are gapping down more than 10 points, you don't want to be buying the market for at least the first 25 minutes. And that's just a personal rule of mine. So 9:55 East Coast time, or if we're gapping up, you don't want to be selling the market till 9:55 East Coast time. And by then, you'll be able to see, is this a gap in continuation or a gap in reversal? It allows you to read the market, read the price action. But one of the things you need to be thinking about as we move into any gap is how many traders are wrong, and realistically, how, can we continue that direction because there are so many traders wrong. So if we've had the last 3 days, all of this price action, I'm going to box this out here, all of this price action right here, everybody's wrong. Everybody's wrong from Monday, everybody's wrong from Friday, everybody is wrong from Thursday. It's a lot of people wrong. So avoid buying the support levels you might have. Every single day I have support and resistance levels that I would like to trade, but that doesn't necessarily mean that is the trade to go with. There's 3 things to consider when trading and using technical analysis. One, price, which is just generally support and resistance levels, which I find using leg start, swing marks, and Fibonacci sequences. The other is momentum, which I do by looking at what is the average true range. Okay, the ATR, which I highlight these yellow bars. This is my average true range. This is a custom code. This is my average true range expansion code. If we are expanding in the direction of the gap, so this yellow bar is a down bar, opens here, closes here, it's 1.5 times the average true range. The first candle 1.5 times the average true range. By the way, the first candle of the day is almost always 1.5 times the average true range. But if we waited 25 minutes to 9:55, you could see there was 1, 2, 3, 4, 5 bars of selling off the open. 25 minutes of straight selling. Do you want to be buying the first low after 25 minutes of straight selling? Probably not. So what I do is I'll set another timer for another 25 minutes, and that's so 9:55. That gives me what would be 10:20. So 10:20 would be right here, and that's really the first bounce of the day. That's the first bounce of the day. But at this point, we're well below the VWAP. We're still expanding to the downside. And just by following this simple rule of avoiding trading against the direction of the gap for at least 25 minutes when the market opens is going to help you from catching a falling knife or shorting a shooting star. So in this specific situation on Tuesday, we're falling. Wait till 9:55. At that time, you're analyzing the market. You're seeing we've gone straight up for 25 or straight down for 25 minutes. Not something you want to buy. And then set another timer before you even decide to step in the market. That'll help you analyze the market and realize that we are moving lower, and the chances are of you going long, not the best. I'll just give you one more quick example in this video. We have a gap up from 43, roughly looks like the close is like 43.85. The open the next day is 44.04s. So that's more than 10 points. 10 points would have been 43.95. We have an expansionary bar to the open, instantly pushing forward. You want to avoid gaps, trading against gaps of more than 10 points. You go up 1, 2, and then let's look at what would 9:55 be. This is 9:55. Well, 9:55, you can see every single candle has made a higher high. We take out the previous day's high at the open. We then expand it up. This is another expansionary bar. New high, new high, new high, new high. Do you want to short? Probably not. If you're so eager to short, wait another 25 minutes for price to tell you what's going on. 9:55 plus 20 is 10:20. So only at 10:20, really in both of these situations, is there even any opportunity to make a couple points to the short side. But by this time, you should realize clearly that the trend is up and give it an opportunity to trade with the trend rather than against it. So just to quickly review this video, if we're gapping up more than 10 points or gapping down more than 10 points, do not fade the direction of the gap for the first 25 minutes. And after those first 25 minutes, do some analysis and decide whether or not the trend is strong in the continuation of the direction of the gap and whether or not you should be fading it. So that's a little tip I have for you guys here today. If you enjoyed this video, please give it a thumbs up. Feel free to share it on your social media accounts and make sure you're subscribed to the YouTube channel because I'll be dropping more bombs like this. Take care.